It's the 10 rap commandments. It's the 10 rap commandments.
All right, lose the paper, lose the deal. Commandment number 1. Guys, why is that so important? It's very important because you don't just do a deal and then that's it. You don't sit back and just collect the payments. Although that is nice, it takes a little bit more effort than that. If you want to make it in this business, you got to do the hard work. And part of this is the hard work is this. So it's lose the paper, lose the deal. I mean that when I wrote that. Guys, what we're doing every damn month, it's not me who's doing it, but we hired a VA. We trained a VA, a virtual assistant, if you don't know what that is. Guys, it could be anybody. It could be your admin. It could be you. It could be your wife, your spouse, your husband, girlfriend. It doesn't matter. Every month they go in. So we log into our portal. So whether it's the Wells Fargo online mortgage, or it's the servicer, or it's the third-party servicing that we hired, or we're paying for because we want to have this done properly, right? We want someone servicing all of our notes. Guys, they're logging in every month, checking the spreadsheet, knowing what loans and deals we have out there, notes, subject to seller finance. In this case, it's a wrap deal. And they're going through every month, checking everything. Now, making sure that we're receiving the money, we're actually paying the money. We've actually done deals where we've caught this before where the servicer wasn't sending the money or they weren't sending it properly. So what they were doing was sending a paper check, and someone randomly made this decision in the middle of our 2 years of doing this transaction. And next thing you know, we started having a delay payment. Well, we picked up on it right away. We found it the first time, we got paid, but we saw a delay. The second month we said, something's up. So we caught it right and nipped it right in the butt. Why? Because we had someone monitoring it. Guys, you can't be eyes and ears for everything. So this is very important. Payments, terms, tracking, portals, everything. Most important, track your deals, document your deals, do it the right way. Commandment number 2, seal the deal with steel and paper is super important, but why am I saying that? A TC is the most important part of this transaction. Any transaction. A TC is a life changer for me. TCs have transformed the game. Guys, the days of me writing the contracts, following up, making sure escrow's opened and all the little title things are getting rectified and the communication between the title companies and me, it took some troubles and tribulations that we went through for you not to have to go through that anymore. So guys, TC, in my opinion, is the #1 respected game inside of a wrap deal. And they're gonna help you get your wrap deals to the finish line. Guys, not to mention after the wrap is done, you still need servicing. And sometimes you can't do servicing until the deal is actually closed. And maybe it's 30 days because you gotta go wait for the deed. Some servicers want their original deed. You have to get that after the closing. Tons of little red tape no matter what state you're in. So get yourself a TC. Guys, if you need a TC, creativedealdepot.com, I'm going there to get my TC. I got a wrap deal under contract or I need to get it under contract. Got the terms already established with the sellers. Boom, calling up my TC. Let's do this. Let's make sure this works. So that's #1. Number 2, be sure we have the terms spelled out correctly. Dates. We want dates down, everything down right. What else we want? Terms, dates, close of escrow. What are we doing? When are we closing on this? Make sure you have all your data ready to go in agreement prior. And number 3, most importantly, is keep all your documents in order. Your TC is gonna help you get your documents together, but it's your job as the investor and business owner to make sure that those documents continue on. So you're gonna keep that recording, put them in a drive, get the hard copies. Super imperative, do your paperwork. 1, 2, 3, guys, super easy. So we're calling this number 3, right? Triple threat, we went through this before. Down payment, first thing, that's how you get paid. Monthly money. Okay, we call it cash flow. I actually call the down payment an assignment. I think of it as in the wholesale game where you gotta pay yourself, right? You gotta pay yourself back. Try to get some money back in to survive, right? Pay for that lead, pay for that deal, put some in the pocket, put some in the business, put back some marketing. Number 3, the big payoff. That's the equity. That's the difference in the value of the home that you should be marking up. So let me show you what I mean, and I call that mailbox money. Let's say that Justin's terms, I went and found a subject to person, a deal myself. Let's say I went and found a subject to transaction. I'm gonna go buy a house. Someone's allowing me to take over their mortgage payments. I'm buying the house for $100,000. It's $1,000 a month, PITI, principal, interest, taxes, and insurance, and it's a 3% interest rate right from that person's loan. All right, I'm taking it over. Subject to the existing terms and conditions. Well, you know what I said? I said, hey, listen, this doesn't work for me. It doesn't cash flow like a rental. Maybe I don't like this area. Maybe I don't buy in this area. I don't want to own so many assets in this area. However, I do want to make money. And you know what the other thing is? We're giving people home ownership. And we call them the end buyers most of the time. It's a penalty box buyer. Guys, listen, you got to be bankable these days. Over 50% of people are getting denied going for traditional loans these days. It's getting harder and harder, and affordability is getting further and further away and attainable for a lot of individuals in America. So this is really a perfect strategy. Justin's terms. I told you I'm getting it for $100,000, $1,000 a month, 3%. Pretty awesome. Let's just say that I found this end buyer, and we're gonna call it Katie. All right? So Katie now says, I can afford this house. I can afford this deal. I'm gonna show you the deal that I'm gonna give you, Katie. I'm gonna charge $150,000 for the house. I'm gonna charge $1,500 a month for the PITI, and it's gonna be a 6% interest rate. Now guys, I'm just giving you quick math, right? So don't judge these numbers. But what I'm trying to demonstrate for you is that we marked it up $50,000, marking it up $500 a month on the PITI, and it so happens we doubled the interest rate to 6%. What we did is we took the existing terms, we put our terms, I put Justin's terms on it. We wrapped it. The end buyer's terms now are these, and that is a wrap. And so how do you get paid? 3 ways. The down payment, the assignment. Well, we could have said, hey, this house cost me $10K to get into it, but I'm charging Katie $20K to get into it. So I just made $10,000 on the down payment. Cool, all right? Monthly payment now, the cash flow that we call it. We said that the PITI is $1,000. That's our debt obligation, $1,000. Well, we are charging $1,500. That the math between the interest rates and how we manipulated this is $500 a month. So there's $500 a month. Every month that mortgage gets paid, till it gets paid off. Big payoff, $50,000. Well, for layman's terms, we're gonna talk about the math. There was a $20,000 down payment. We can say that technically the house is $130,000 now. So there's gonna be a separation between the $100,000 and the $130,000. I took off the $20,000 that she gave. Now the equity, there's a differential, there's a spread. At minimum $30,000. But the longer you pay down that house at 3%, our payment's gonna go down quicker than the 6%. So guys, there's an equity spread. So one day when that seller refinances or sells that property, gets a payout, there's mailbox money that's coming one day. 30 plus K, minimum. So guys, that's the 3 ways of getting paid. Follow me, follow along with the wrap series, the 10 wrap commandments. I feel near and dear to my heart about wraps. But guys, it's just one of the many creative finance strategies that we can deploy and make money with. Commandment number 4, follow the rules, avoid the fools. So what I mean by this is, it's super important. Guys, if you do things unjust or by the seat of your pants, even if you are unaware of the laws, you still can get some you can get some handcuffs put on, all right? And guys, we don't want that. One of the biggest things with a wrap is an RMLO. What is an RMLO? An RMLO is a residential mortgage loan originator. And guys, what they do, that's super important. This will cost money. When you find your buyer, okay, you're gonna find your end buyer. What's gonna happen is, you have this nice house that they want. They said, yep, I'll do it. Here's the terms. I agree to your terms, Justin. We just went through it in commandment number 3, right? But we're gonna go through, we'll say it's $150K, $20K down, $1,500 a month, you know, at 6% interest rate. Perfect, I can do that. Well, can you? Here's the deal. What you need to do is you need to take these set of terms and you're gonna take this end buyer and you're gonna put them through what we call underwriting. And they're gonna find out if this person is qualified or not. They're gonna find out whether this person is qualified or not through the residential mortgage loan originator. It's a third party who's gonna say, yeah, okay, I see your income. Oh, you have a job? Great. You make cash? That's cool. Do you see it? Do we have a bank account? And what they'll do is they're gonna give you the blessing, the thumbs up or the thumbs down on whether or not this person is qualified to buy your deal. That's gonna keep you from getting in trouble and being a predator, predatory lending, and being a shark. Guys, we don't want any of that stuff. Super, super, super important. RMLOs, underwriting, qualifying your penalty box buyers, making sure that they are getting into a deal that is fair. And that's all it is. It's fair trade laws, fair practice. And guys, in creative finance, we got rules to play by too. When you play by the rules, you will be successful. Everyone's trying to do something, skirt the laws, skirt this, skirt that. Listen, get with the program, get with the times, follow along. We have to do good business. So here's a few more examples of how we stay compliant, how we as investors, as good business people, continue on doing good business. Guys, follow your state and local laws. Super important. You gotta know what you're doing in that state. Are lease options okay there? Are executory contracts, are they gonna be a bond for title, bond for deed? Guys, all these things you gotta know. Super important. Check your state and local laws. TILA, Truth in Lending Act. That's an older one. It was formed, I believe, in the 80s. One of the biggest ones that we now read up on is the Dodd-Frank Act. That specifically came from the early 2000s and a result of some bad practices and some bad actors doing things with those adjustable rate mortgages and all that. Oh, it was terrible. Guys, we're not gonna get into that. What I need you to do is to look up the Dodd-Frank Act. I just need you to look that up before you do anything, but it's gonna pretty much protect yourself with an RMLO when you do business. If you're gonna sell a deal, get an RMLO involved, let them underwrite it, make sure that person's qualified. And guys, that's majority of the things that you need to worry about. Follow the rules, guys, and the raps will continue on. I'm Justin Tumanowski. You're watching the 10 Rap Commandments. You just watched commandment number 4. Follow the rules, avoid the fools. Get with your RMLO, get with the Dodd-Frank Act, get with TILA, figure out what you need to do when you find your last end buyer and you're gonna give that deal to somebody. Make sure you put them through the right steps. Commandment number 5 today, we're gonna talk about how you're still gonna be able to do these deals even if your buyer isn't ready to close. Maybe they didn't bring all the cash for your down payment. We talked about that in another commandment, the ways of getting paid. Sometimes the buyer isn't ready. Maybe they need to graduate into homeownership. Maybe you're gonna do a test run. So that's what this is all about. You don't have to be so rigid. You can still make these deals work. You can still give buyers an opportunity to then rent to own. The biggest point here is flexibility is in your favor. And these are the tools that can keep you flexible, but keep you successful at the same time. So let's follow along and I'll go through the few steps on commandment number 5. Pivot when needed. Lease options are your best friend. But also, guys, it's not just lease options, it's contracts, all right? So let's go through those contracts right now. And these are paperwork and different types of agreements that you can go, so check your state and local laws and understand that not everything is going to be the same name, same verbiage. So just double check with your title companies. And guys, we have a title company, all 50 states. Make sure you use it. We'll probably put that link below. Guys, lease options, that's what we're talking about right now. So think about rent to own. You're gonna lease the property to somebody with the agreement that they could purchase it at some point for a predetermined, set price, time, and money. So land contracts, bond for deed, agreement for sale, executory contracts, and master leases. Guys, master leases more in the commercial sector and multifamily, but again, we've heard of master leases. Guys, check these things out, look them up. They are gonna protect you, but also allow you to cash flow, give you the ownership, and then when that homeowner or that end buyer is ready to fulfill their obligation, they can execute. But hey, listen, if they don't, get the property back, because you're still the owner, go do it again, rinse and repeat. Go get your down payment. Go out and get the new buyer, get the down payment. Maybe the price of the value of the home has gone up, so you can charge more. Maybe the rent and the value that it's worth has gone up, so you can get a monthly cash flow, even better. So just rinse and repeat, guys. This gives you the control of the property, and this is around a wrap. All right, guys, so check it out. Lease options, land contracts, bond for deed, agreement for sale, executory contract, master leases. You heard it first, wraps of the game. Stay flexible, stay ready when the market demands. You got these contracts here, you got these extra agreements, you got the knowledge. This one is tough but necessary. And I want to give you a quick little tip. This is actually for landlords too. And because you are becoming a lender, in this situation, you're a note holder, and most often you might still own the property. If you were checking out commandment number 5, you would know that you might have a bond for deed or a land contract, so you might still be the owner of these properties on record, on title, and then you're going to give the option to buy to these folks. So you're still essentially now becoming a landlord. You are still controlling the property. And sometimes things happen to these folks. So you have to control this asset. If someone stops paying, you need a quick and easy way to get folks onto the next chapter, get them out of the asset with less damage as possible to keep on moving forward. And I'm gonna give you some of those strategies right now, guys. So if a tenant stops paying and one of your lease options potentially stop paying, wrap buyer, bond for deed, what happens when someone stops paying? Even if you're a landlord right now and you have 1 or 2 tenants, what are you going to do? Are you going to go through an eviction? Are you going to go spend, $5,000, $10,000 on an attorney with the retainer? And then what? Let the tire get kicked down the road for another 30, 60, 90 days, depending on the state and the local politics. Guys, I've been through it. It's not fun. So guys, one of the little strategies we offer, but we've been very lucky because of our qualifying of buyers. We're vetting our buyers, we're vetting our people, and we're also being upfront and transparent. And we're also communicating with these folks on a daily basis. We've had some people that are having a struggle that they might be a little bit late on their monthly payments. But guys, we're working with them. We're gonna hold their hand down the road so that we don't have to go through tough times and problems and tribulations. So guys, a little bit of upfront human-to-human contact, because after all, guys, we're in the people business. Don't forget that, we're in the people business. So a little bit of upfront communication, help, compassion, empathy can get you successful. Now, there's a fine line, and we're not going down that road today, but there's a fine line between treating people like humans and also being taken advantage of. But guys, here's a good one, cash for keys. It's an exchange. Someone stops paying, you're starting to see what's coming down the line. You might just go, hey guys, listen, let's call it what it is. You're not gonna be able to make these payments anymore, you're struggling. So in order for you not to have an eviction, I have to go through a foreclosure or whatever the process might be, let's get this show on the road. Let me give you $1,000. Let me get you security deposit for the next stay, for the next hotel, for the next apartment. And let me give you that. You just walk away, agreed upon. You're not gonna trash the place. You're gonna clean it out to the best of your ability. And we're gonna just amicably walk away from each other. Guys, I'm telling you, would you rather pay a $10,000 retainer to an attorney who's just gonna keep draining you? Or do you wanna pay $1,500, $2,000 to get someone out peaceful, or do a long-term eviction? It's not just 10 grand retainer. It's loss of revenue, damage to the property, mortgage payments that you're paying while you're not getting paid. So guys, next thing you know, it's $20,000. Be very, very smart about this. Don't let your pride get in the way. So guys, cash for keys, waived evictions. There's a documentation. You can postpone an eviction. You can say, hey, we're gonna postpone this eviction until further notice, until if you do X, Y, and Z, we will do our part. Relocation assistance. Hey, I'll help you get to the next step. Help you get to the next checkpoint. No eviction on the record. I mean, that is a big one, guys, because let's face it, if you give them an eviction on their record, forever, they're up against the wall. Debt forgiveness. Maybe you forgive some of the back rent. Maybe you forgive some of the security deposits. I don't know. But again, this is more of the cash for keys thought. Storage solutions. Exit, take what you need, take the clothes that you need, take the goods that you have, put the rest in storage. I'll pay for 3 months of storage. Guys, be flexible. These are all tips and suggestions to help you get successful in your wrap game and on your creative finance contracts. So guys, follow along. It's not the easiest game, but if you follow the 10 wrap commandments, I'm telling you, a lot of these things and the tips and tricks that I'm giving you in this little series are gonna help you be successful. Just give you the knowledge on thinking of the few extra things that we all can think about. The right people in your corner, it's gonna be pivotal. Guys, if you like what you're getting, you guys need a TC, you need a partner, go to creativedealdepot.com. I'm telling you, those guys over there, you're gonna get the right TC, walk you through the whole process. The best TCs in the business. Guys, be smart. Know when to cut your losses on these wrap deals and these real estate games. It's all about humans, people business, and we need to treat people like humans, but we also need to protect our assets and protect our investments. All right, guys, let's talk about protecting your investment. And guys, if it's not insured, it's not assured. And guys, you are liable. If it's not insured, it's not secure. Here's what to do, follow along. Your buyer needs insurance. There's no ifs, ands, or buts about it. And guys, more importantly, you're gonna get different opinions here. And everybody has an opinion when it comes to everything in life, right? So do it at your own risk and your own merit. But guys, the title should reflect the policyholder. What does that mean? If I am the owner of this house, I'm on title. I'm the owner. If I want a primary policy, if I want a policy to cover me, I better be listed numero uno on the policy. That should reflect the primary person. If that's your end buyer, what should you be? You should be an additional insured. What that gives you guys too is anyone listed as the additional insured, now your original sub 2 owner, they're gonna be listed. the bank's going to be listed, any other lien holders or additional insured will be listed. But what happens with that is anytime the policy changes, everybody gets notified. Well, that's also a good thing and a bad thing. So you got to be very careful. If that end buyer stops canceling, they stop paying the mortgage, guess what happens? Hazard insurance kicks in, and next thing you know, the mortgage is paying the insurance, they're looking at the title, they're looking at the deed, there's your due on sale clause. We're not going to go down that road, but this will help you prevent those triggers being notified. So additional insured, notifications, super important. TC, guys, I've said it once, I'll say it again, get yourself a TC. I just had some folks that came to us for coaching. So I did some coaching with them within the Sub-2 community. They decided to start going on their own because they don't want to pay a TC fee. Now, when you align yourself with a TC, you'll get better pricing, you'll get in-house pricing, you'll get like the best of the best. Of course, people can't work for free. These transactions take hours. Sometimes these things are 40, 60, 80 hours of work, and you're paying $1,000, $1,500 for it. So, and not to mention you're getting extra sets of eyes on your deals. Do not skimp out on that. I'm telling you, go to creativedealdepot.com. Go get yourself a TC. They're the best in the business. They'll walk you through this. They'll walk you through and also help you get the insurance. Get you to the right people for that. Get you your third-party servicing all set up. Guys, you heard it. This is commandment number 7. Get your insurance. Do it the right way. Be assured that you can now sleep at night knowing that you're going to collect your money every month, you're going to be successful in the end, and your assets are going to be protected. We're at number 8. Don't flex, protect your checks. All right, guys, so here's the deal. Wraps can make you a lot of money, but if you over leverage yourself and don't protect yourself and protect everybody else, they can put you in a bad spot. I'm going to give you guys an example of a Sub-2 deal, and I want to break it down, and I want to ask you at the end of this to see what you think. Is this a deal that I personally should be going into? Meaning you, if it's going to be right in the right season of your investing career. It doesn't mean it's not a bad deal, or it doesn't mean it's a good deal. It just means you need to actually gauge to see where you are in your investing career to see if this actually makes sense for you. Guys, we get a Sub-2 purchase. I just made these numbers up. It's a $300,000 house. The entry fee is $45,000. That's over the 10%. Now, 10% is a fictitious number that we made up that we feel is a good gauge where you should put your entry fees according to the value of the home, purchase of the home, to what you are actually putting in your entry fee. So that's $45,000. PITI, monthly mortgage, $2,000, made it up. But guys, now let's break it down. You're gonna go sell this deal. You said, hey, you know what? This is a good deal. Someone's giving me terms, someone's giving me a subject to mortgage. I don't feel like being a landlord here. I don't really own assets here. I don't really want to be responsible so much for the upkeep of it, the maintenance, the property management, the lawn care, all the things that come with property management, right? And a rental. So you said, you know what, let's wrap it. Let's give it to a family that actually maybe deserves it and needs it and wants it. So you said, great, I'm gonna mark it up to $350. So we mark it up to $350, entry fee. Here's the problem. Most often I've been seeing folks, they get into these Sub-2 deals at $45,000, but they can't find a wrap buyer to supply the remaining entry fee. You know, if you're gonna go in at $45,000, you would at minimum want to break even at 45, to 50K entry to try to not leave money in the deal. You're only getting $25,000 as your end buyer's entry fee. Okay, so hold that note. However, you're able to mark up the PITI to $2,600 a month. That's plus $600 a month. Don't forget, your original wrap purchase at $2,000, you're marking up to $26,000. Your end buyer, if the taxes go up, they should be responsible. Insurance goes up, they're responsible. So you should be seeing a lot of that $600 every month. What does that look like? So if they gave you $25,000 out of the $45,000, you're leaving $20,000 in the deal. Okay, how many months does it take to make up that $20,000? That's $600 a month. That's 33 months, but it's a 36% ROI year after year, because you're making something like $7,200 a month on that $600 a month to make up for the $20,000. It's a good return on investment. However, how did you get the $45,000 to buy this deal? Did you borrow that money thinking you were going to get that $45,000, $50,000 back? That's where I've seen people get into trouble, because they think they're going to be able to get their end buyer to pay for it. But next thing you know, they can't get it, so they're leaving $20,000 in the deal. Now, if it's your money and you choose to, or you and the private money lender, whoever is giving you the money to do this deal, if you're okay with leaving $20,000 in the deal, that's great. I mean, it's a 36% ROI. Maybe you make $100 a month. They make $500, they get paid back quicker. And then when everyone gets their money back, you guys can split it up. Now, great, that's again, perfect. I don't know what the ROI is on the $500, but it's probably better than 20%. So guys, think about that. Really good interest rates. But where are you in your seasonality? Where are you in your investing career that you're gonna go borrow money, buy a sub 2, have a wrap buyer come, but they only give some of the down payment down? That's what you need to ask yourself. Now, if you can weather the storm and you understand, nope, we understand we're gonna leave money in the deal, perfect. Do the deals. Don't over leverage yourself. That is over leverage. But also, what if this person stopped paying? What happens? What are you gonna do? Do you have the coffers, the war chest to supply, to sustain the storm? Ask yourself that question too, please. So that, build reserves. You have to build reserves. 3 to 6 months minimum per deal, per house. You should have ready to go. If someone stopped paying you for 3 to 6 months, ask yourself that. Plan for the worst. Do you leave money in the deal? We already talked about that. But guys, what I also want to talk about is the 10 wrap commandments a little bit deeper on this video, and I felt like we went a little bit deeper than normal. But I also want to talk about how do people win with you. If you're okay with leaving money in the deal and your private money lender is okay leaving money in the deal, that's perfect. I love that. Everybody should win. That lender gets to win. They get a return on investment. You're winning because you get monthly, maybe a down payment, maybe the equity at the end. Like, great. Synergy. Perfect. How to get others to win? Private money lenders. Talked about that. Guys, TCs. Make sure your TCs are doing these deals. I said it once, I'll say it again. TCs should be winning. JV on deals. Guys, don't go at this business alone. I'm telling you, wrap deals, they're great, but they are complicated. There are some complexities around this. They do take time. Don't think you're gonna sell it in 30 days. Give yourself 6 months. Bring in buyers. Someone can bring in buyers. Someone can speak Spanish. Someone can speak, I don't know, Italian, Indian, whatever it is. Having that ability to translate, my goodness, has paid dividends in our business. Maricela Hernandez, this aligns with some of her passion. She wants to bring in Latino buyers and give people home ownership. That aligns well with our team. She's great at supplying and speaking to Latino individuals, buyers, and we're bringing the deals. Do smart deals. Don't flex too hard. Protect your checks. Protect your business. You don't have a deal unless you have a buyer, right? Some of the most important individuals who are going to actually be your wrap buyers are some of the underserved, underprivileged folks in America. Folks that deserve, want, desire to have home ownership but can't. And I'm going to tell you a few examples on how you can find those folks, but also who you're looking for, I think is more important. We're looking for penalty box buyers. Penalty box buyers are some folks that may have been turned down by the financial institutions who may have went for a mortgage and lend the bank and they got turned down for one reason or another. Over 50% of people applying for loans from COVID till now, and it's getting worse, are getting denied these traditional bank loans. So your wrap deals, seller finance, owner finance, lease options, these are all really good opportunities to obtain home ownership. Guys, think about this for a second. You, a family member, cousin, brother, sister, mother, I don't care who, they're looking for home ownership, they've been renting, putting some money together for a down payment, showing income, having a job, showing steady reserves. Guys, you can get home ownership without using a freaking bank. How dope is that? And not many people know this, so I hope people watching at home right now and people watching sitting there on social media, think about this. Who needs a home? How do you get one? Get off your keister, watch the wrap series, dig further into owner finance, seller finance, wraparound mortgages. I promise you, you're gonna have some good success and you'll be able to get something. You just have to look for it. Penalty box buyers, we talked about that. Buyers, lenders, they've been turned down. They still can qualify through an RMLO for a loan. They can still qualify with us. We can still vet them. I-10 and green card, like I said, undocumented, you could buy a house in a wrap deal and qualify if you're undocumented. That's what the I-10's for. Another way of giving someone who's undocumented, not here legally, the ability to pay taxes because they freaking earn income. They want to pay taxes, they want home ownership, they want to be legal, they want to be a resident, they want to do things right. They want to be here. That's what that's for. 1099 workers, guys, plumbers, electricians, freaking trade workers, anything providing a service, being a subcontractor, it's incredibly hard to get traditional financing. Perfect. Latino, Hispanic communities, some of the most prominent, predominant, common individuals seeking these owner and seller finance deals are just that. Have someone on your team, by the way, little secret, have someone on your team or have someone at your disposal, have the ability to communicate and convey these real estate terms in Spanish. Cash earners, not bankable. Guys, you can make cash. You can be a cash farm worker. We've seen so many different avenues. Heck, you can be an entertainer on a pole, making cash. You're just not bankable. Do you know how to make income? Can you prove that it came from somewhere and not, money laundered? If you can do that, you can get deals. Just a few examples on knowing your buyer or things will backfire. Arguably the most important, always have an exit. Number 10, I'm paying tribute to Notorious B.I.G. in this whole series, guys. One of my favorite rappers, if not my favorite rapper. We taught the rap series in the Sub 2 course. If you're a Sub 2 member, you can find me in there teaching some of that course. We've done rap deals, we do them on the regular, and I want you guys to get some value from this. Always have an exit plan. Guys, I want to break it down for you. Like Biggie said, consignments for suckers. Don't leave yourself open, don't leave yourself vulnerable. Markets default, markets shift, buyers end up losing their job, things happen. So what I want you to do is protect yourself, stay in tune with your deal, always stay abreast. I wanted to show you here that, all right, cool, you got a deal, you found your wrap buyer, perfect, awesome, good job. 6 months later, they stopped paying. Things were great. You got an income, you've got money, you got your down payment, 100% paid back. So now it's an infinite return, but if you're not too, that can be a lot more painful. What would you do? You need to take the property back. That's why knowing on what you're gonna sell on, what type of contract, is gonna pertain and correlate with what type of seizure you need to come back with foreclosing on somebody or getting the property back, retaining that ownership. Sell your terms. If you get the property back, sell the terms back to another investor. Give them your terms and say, listen, I'm walking away. Maybe by then markets shift, industry came in, jobs came into town, whatever it is, right? There could be the change in ownership and the change in demand could have shifted. So be aware of that. Just sell on the market. If you got equity, cut your losses. Maybe there's paying an agent and maybe there's, 10 grand, 20 grand to make out of the deal. Get your equity out of there. Third party, always using, pad split, for instance, rent by the room, corporate housing, co-living model. Guys, all strategies we've deployed, taking back either deals, looking at deals that we've looked at 7 different ways and said, we can wrap this, but maybe we want to take this down. Do we want to own this? What is the best exit? And sometimes we've come across these great opportunities, these great assets, these great deals in these great markets, and we look at them and we go, all right, there's 5 different ways right now to make money on this deal. What is the best? What's the worst? And what happens? So we stack those according to the best to the worst. And we'll just go down that row and see if we can execute. Super easy. But last piece of this, protect your spread, multiple strategies, you need to have them. Stay liquid and monitor your buyers. You've heard it, guys. This is the 10 wrap commandments. I hope you've gotten value from this. I hope you've had a good experience. I had fun doing this, making this. Shout out to Biggie Smalls, best rapper out there. Yes, I said it. Yes, you can make some comments. And if you don't like it, pound sand, East Coast, baby. Thank you for tuning in. Follow along, do good deals. Go to creativedealdepot.com if you guys need a TC, you guys need a JV, you guys need people to help. And guys, I'm Real Estate Justin. I'll see you on the next one.